Welcome everyone who joined. We are going to start in about 5 minutes from now, so feel free to hang around in the chat and tell us who you are from, where your company is based, and maybe what industry you are from. Welcome everyone who just joined. We are going to start in 4 minutes. So just feel free to hang around and tell us where you're from in the chat. Whether you are joining from LinkedIn or YouTube, we can all see your chat in the post, in the comments. So just feel free to hang around. If you have any questions, just feel free to also ask them as well. We do have like a dedicated Q&A. And we'll also be taking questions during the presentation. Hi, Ray. Welcome. Yeah, where everyone is from, for whoever is in the room right now. I'm hailing from Houston, so probably different than most of you guys. I assume most of you guys will be from California.
I'm in the Bay Area.
Yeah, we'll be starting in 2 minutes. So just if you are pouring some coffee or drink some water or need to use the washroom, make sure you come back in like 2 minutes. We will be starting right on 5:05 Pacific time. Hey, Abraham. Yeah, I've been to Sunnyvale just like 2 months ago. Hi, John. Yeah, another San Francisco. Right. We'll be starting in around 2 minutes from now. So feel free to hang around. And if you have any questions, we will be taking them both at the end of the presentation and also during the presentation. So if you're coming, like if you're a founder, especially coming with some questions already, feel free to post them in the chat. We'll be taking them throughout the presentation and also at the end. So don't worry about that. Yeah, Yao-Qi is also from Sunnyvale. Yeah, a lot of Sunnyvale and also Bay Area people. Palo Alto. Hi, Yi. Yeah, seems like we are right on time, 5:05 right now. So we will be getting started very briefly. Yeah, so let's get started. On the agenda for today, we are going to have a 1:30 or 1 hour and a half agenda. The first hour will be the formal presentation by Jie, which I will introduce formally later. And we will be covering several topics, including but not limited to general overview of tax reporting, entity structure, tax, due diligence, and common information request by investors according to Jie's experiences. And during the last half an hour, we'll be taking Q&A from the audience through the comment section. So whether you guys are joining from YouTube or LinkedIn, just type your questions in the chat and send those to us. We will be taking questions in chronological order, meaning if you send your questions earlier, we'll be answering them earlier. And I want to also note you guys that if you have joined us last week during our law section, we will be a little bit different this time in the way that we will be taking questions midway. So during the first 1 hour. So whenever you guys feel, you guys have follow-ups or you have some questions regarding GS explanations, just feel free to type out those questions and we will be taking those questions as we see them. Yeah. And also, if you don't feel like you have other questions, you feel you have company specific questions, feel free to raise them during the last half an hour. Yeah, and that'll be it. So maybe let's get started to the presentation page. Yeah. Okay. Before the formal presentation, I'd like to welcome our guest speaker today. So Jie Zhu is a certified CPA and international tax partner at PP&Co, which is a full-service accounting firm with over 70 years of experience serving Silicon Valley and clients worldwide. Jie has over 25 years at the firm, leading the international tax department, where she specializes in global tax planning and compliance for business and investors. And Jie is also an advisory board member for the Women Leadership Program at the University of San Francisco and was recognized as a 2019 Woman of Influence by the Silicon Valley Business Journal. So without further ado, let's welcome Jie to the stage.
Hi, welcome to join us today. And I will share my experience and knowledge in the startup and founder taxation field. And even though my experience are mainly focused on international tax, I work a lot with the startup companies and founders for both US domestic startups and international startups. So feel free throughout the presentation, feel free to ask questions regarding domestic or international questions if that's applied to you. And as Jack said, we'll answer them as they come in. We'll get started. And first slides. Okay. All right. So sometimes people ask, okay, what are the general procedures for tax reporting? And why do you guys need to know so much about this? As of so many questions, right? And for example, from a business perspective, and we ask for structures, and it's not just your first layer of investors or first layer of funders, and we ask for the up and down all layers of direct and indirect shareholders, and if you own any subsidiaries, branches, and we need to know all of them and why. This is really because we need to understand the full scope of the structure in order to determine if there's any required reporting. Just give you a very quick example. Very often that businesses here have foreign investors, and if the company has a 25% foreign shareholder, and there's any transactions between the U.S. operation, the U.S. company, with the foreign or domestic related parties, then that related party transaction needs to be disclosed on U.S. company tax return. And if that's missed, let's say I have three related parties. The related parties could be your direct investor, could be your indirect investor, could be officer or other people or other companies under common control. So there's a lot of related party transactions that could be required to be disclosed. So for example, if I have three related parties, and then I need to disclose on 3 different forms of the transactions with those 3 related parties, and I miss them, and each firm is a $25,000 penalty. So that's why we ask questions. So if your tax preparer or CPA does not ask questions, that's actually when you need to be concerned. So when they ask questions, please help to answer them, address them, because that will help to for us to really understand the scope and making sure the reporting are appropriate, and also helping us to help you to minimize the risk. And so often that we not often, like for business, we always ask about state activities and why, which I will touch on later as well. And because often that I saw one questioner say, which state will be the best state to start a business regarding tax and other finance related benefits from government? It depends, because often client asks, oh, can I set up my company in a state that has no corporate tax, and that will help me to save taxes, right? And yes or no, it depends. So because each state has different state rules, and we need to consider state nexus. Essentially, that's how closely you're connected to a state from a tax perspective. All states have different rules. They have different considerations. For some states, it may be that, okay, even though you don't have any customer here, but you have personnel here, then we'll consider you are closely connected with us, then therefore you need to register and file tax returns. And some states say, okay, I don't really care if you have anybody, but as long as, even if you have nobody here, you have no office, no facility, no warehouse, nothing here, but you have customer here. And if your revenue reaches a certain point, then we'll consider that you closely connect to us. For example, California. And even if your company is registered in Delaware, in Nevada, or in any other states, there's no state tax. But if you have certain activities like sales that reaching certain threshold, then you're still subject to California tax. So it really, when it comes to state, you really have to consider where the company, the operation could be, and where the major customers could be. And so it's not a yes and no and black and white question. And also that there are special rules about R&D which I'll touch on later on. Of course, the firm operations, which can make the reporting a lot more complex. If we don't ask questions, then things get missed, and there are pretty substantial penalties. From individual perspective, the same. And we ask questions, and so truly to understand that what could be going on, right? And are there any significant changes? And also from a planning perspective, that what are the future changes that's coming up, right? Which could be change in marital status. I have an exit. My company will be sold, and things like that. And so this will help us to us to advise on the tax consequences, and also to identify if there's any planning opportunities. So please help and to provide information when your CPA asks for them, and to help them address the questions. Next. Okay, so we'll start with from the startup company perspective, what are some of the common things that they need to consider, and we will dive into details in the entity structure and taxations. So these are the things that a lot of startups that they need to consider, and mainly this does not focus only on tech companies, even though tech companies are the most are the startups. They do, right, are in the tech field. So the entity structures, which we'll touch in more details, the tax compliance, we'll touch on later, and also the financial reporting. A lot of the companies, when they first started, that they are not really keeping track of their transactions or their books, and often that, especially with the first year and startups, and when they approach us or for tax reporting, often we get our bank statements, and there's no financials, and there's no, sometimes we ask, okay, what are these transactions for? And the founders, because they're so busy with their daily life, with their work, with their running the business, and it actually quite often say, I don't remember what that transaction was for. And so at the very beginning, when the transactions may be immaterial, and meaning that would that impact greatly of your how it's being reported for tax purposes, it will not have material impact. So the risk is low. And can you get away from not having a the financial statements on a regular basis? I would say the first year, yes. And however, if your business is growing and has more and more transactions and you're attracting investors, and I would highly recommend that you start to look into setting up a using accounting software to keep track of things. We get requests pretty often and say, oh yeah, investor is asking us for the financial, can you give us tomorrow? And my answer is always no. We don't even know what are the transactions. So keeping track of have a good system, keeping track of the transactions, and also making sure your financial statements are updated on a regular basis, and according to the U.S. GAAP, the U.S. accounting rules, and it is important. And even if you are not able to keep track of it on, like, say, have a monthly financial statements, I would say the very initially a quarterly is a minimal that you should do. And of course, that startup will also have like a banking and financing needs or human resources payroll, and that will, because they also have like investors and asking, when they do fundraising and investor, even sometimes even for the convertible notes, and when people want to lend money to the company and through convertible notes, we have seen that due diligence request, and just for the convertible note investment. And so at the bottom line, what I want to say is business is important, but there are other things that should be paid attention, and because they will help you to run the business smoothly, and they will help you with the fundraising smoothly, and which I will talk about, touch on why a little bit more later on. Next. Okay. Let's talk about entity structure, and well, why it is important, right? Because it's not only impact how the entity is being taxed, but it also depending on some other, like from a founder's perspective, like the different structures will make difference when it comes to taxation, and not on a year-by-year basis, but also when you have exit, and that could impact how your capital gains being taxed. And also depends on the company's like fundraising goals and what are they looking for, and different structures may be used and to accomplish different goals. And I'm not an attorney, I don't practice law, but since we work with startup companies for many years, and based on our observation that C corporation is the easiest when it comes to like fundraising, and because that's what the investors often, they would like the structure to be a C corporation. Next. All right, let's dive in a little bit more detail about each type of structure, the common ones. So C corporation is the most commonly used, and that it files its own tax return because it's a standalone, not just for legal purposes, but also for tax purposes. It's a standalone entity, and there's entity level, the C corporation level tax, and there's also has the shareholder level of tax that when the C corporation distribute dividends to the shareholders. So essentially for C corporation, there are two levels of taxes. And I mentioned a little bit about on one of the earlier slides about why we ask questions and why we want to understand about the structure. And partially is because of the we need to understand the foreign ownership and related party transactions, which needs disclosure, and the omission of that will lead to pretty substantial penalty. And C corporation we will touch on the QSBS and qualified small business stock. And I think as a lot of you are already aware, we'll touch on in more details on the QSBS planning later on when we talk about the founder taxation. But in general, C corporation stocks could be considered for QSBS, and which is not available to any other type of business entities. Of course, are some detailed requirements, and let's say it has to be a U.S. domestic C corporation, and there's a holding period, and there's initial issuance requirements, and which we'll talk about later. Next, S-Corp. Is S-Corp commonly used by startup companies and not for tech companies? But it is, it is used for some other small businesses and family businesses. And if they don't have, a huge fundraising requirements, they don't really looking for exit anytime soon. With S-Corp, is essentially S-Corp itself is not a legal type, is a pure tax type. And the C corporations can elect to be taxed as S-Corp, and there are restrictions. The restrictions, like in what's on the chart on the left, is there's a number of shareholders, and there's type of shareholders, and cannot be any foreign person. C-Corp allows both domestic and foreign shareholders, but S-Corp does not. It can only be U.S. domestic shareholders. And there can only be one class of stock. So because of restrictions that it is less common for companies to use, then S-Corps do file its own return, and it's not subject to federal level tax, but is may be subject to state tax, such as in California. The shareholders, S-Corps are considered pass-through entities, meaning that S-Corp pass through the income and losses to the shareholders. And the shareholders will get a K-1 from the S-Corps, and they will report that the allocated income loss on their own tax returns. And again, the S-Corps, the stocks do not qualify for QSBS. Next. Partnerships, and a lot of times like limited partnerships, and how is a partnership taxed? And by default, and it's a partnership, which is a pass-through entity, meaning that the income and the losses are passed through to the partners and through a K-1. However, the partnerships, if they so choose, that they could file a checkbox election to be a C corporation, and then after they elect to be a C Corp, then they may want to elect to be an S Corp. So there's are layers that they could do, but we don't see very often of partnerships elect to be corporation. And just want to mention that even though I understand the focus today is not on international side, but I do want to touch on briefly for a partnership, and that if that has a foreign partner, then there are special considerations. And not only that, the foreign partners need to file a U.S. tax return, and if they get a K-1 represent like the tradable business income and losses, and they also need to do certain withholding tax on a quarterly basis if there are any allocable income to the foreign partners. So and that goes with both federal and state level, so it can be pretty cumbersome. A partnership, the ownership qualifies for QSBS only if it's a C Corp for tax purposes. And does that mean that I converted today to C Corp and I sell my business next day, that I'm going to have the benefit of the QSBS? No. And you still have to meet the holding period and the 5-year holding period requirements and some other requirements, and it's not automatic. Also, that just be aware. Let's say I convert an entity from a non-C-Corp to a C-Corp, and the capital gains that before the conversion generally is not qualified for the QSBS treatment. But after the qualification, after the conversion, if the shares meet the QSBS, then any appreciation after that could qualify for QSBS treatment.
Jie, we have an incoming question from Ray. So the question goes, is it easy to change from one type to another? What if I started my business in the wrong type? Just close and start a new one?
There are legal conversions, or there are tax-only conversions. So, for example, if you have a, let's say, Delaware LLC, and you say that I'm not satisfied with this type, I want it to be a corporation, you can do an official legal conversion, convert that to a corporation. And or you say, I'm okay with whatever the legal side of that, but I don't like how it's being taxed. And you could file, we call it a check the box election, is a form 8832, and you can file the form and check the box, and for it to be a different type for income tax purpose only. Okay, so you could convert it legally, and or you could convert it for tax purpose only. So there are two types of conversion that could be considered. And for the most part, that both U.S. domestic and foreign entities can file the checkbox election. And for example, if your company has a foreign subsidiary, wholly owned foreign subsidiary, and there are special rules on how that's being reported, how the profit from that or losses being like considered for U.S. tax purposes. Let's say I don't want that. I want easier, more streamlined reporting, and I don't want to do the special calculation of my subsidiary profit and how that's being rolled into my foreign parent company's tax return, and I want it easier. Then you could file the checkbox election for the foreign subsidiary to be a disregarded entity for U.S. tax purposes. When you do that, it does not change how it's being taxed in the foreign country. It does not change how it's being considered legally for U.S. and foreign purposes, but it does change how it's being considered for U.S. income tax purpose. But of course, there are limitations on that, and there are certain type of foreign entities that's called per se corporations, and RS has a list of that in the tax code. If it's one of those per se corporations, and the only like tax type it can be considered is a corporation, and but if it's not one of those per se corporations, and you have the option to make that election, checkbox election, and this strategy is actually often used when we work with people for pre-immigration tax planning as well, because often that people have a lot of like foreign entity investments, and this is one of the strategies we use. So there's a lot of things that can go with this. So, next, LLC, limited liability company. This is something that's very common as well, but when I say common, that it's not common in tech companies again, but it's common in some other type of businesses like service industry or like real estate industry. And as listed on the slides, there could be two types of LLCs. One is a single member. There's only one member that owns 100% of the LLC. One is a single member LLC that by default, if nothing being done, by default is a disregarded entity. When it's a disregarded entity, the single member reports everything on their own tax return. And it doesn't not matter its profit and loss, and they report and being taxed with the other income for the member. A single member LLC is allowed to file checkbox election to be taxed as a C-Corp. Then all the C-Corp tax rules apply. And then it can also elect to be a S-Corp after it files, elect to be a C-Corp, and then S-Corp rules apply. Very similarly for multiple member LLC, the only difference is the default taxation type is a partnership if you have more than one member, and then partnership rules apply. Then and again, this can be a C-Corp or S-Corp if you so choose, and then the various rules apply. Okay. The same as with a partnership, that the firm LLC members need to file the tax return if the LLC is a disregarded entity or taxed as a partnership. And it qualifies QSBS only if the a C-Corp corporation for tax purposes. And again, what I mentioned when we talked about the partnerships, and also apply that it cannot be I convert today and next day I qualify for QSBS. Still need to consider how long you have hold, and also how to split up the capital gains. Next. So for a business, what are the common types of taxes that they need to consider? And these are just the major ones that we run into on a daily basis: income tax, sales and use tax, and payroll tax. And I will talk about the income tax in the next slides. And so I will touch on a little bit on the sales and use tax and payroll tax now. And so for sales and use tax, that I mentioned one concept, the state nexus, right? And when I talked about income tax and how a company or a business is considered connected with a certain state, there's a similar concept, state nexus, for sales and use tax as well. And each state have their own rules, and so that in different industry have different, like certain things and services or products may be taxed in one state, may not be taxed in another state. And there's also if you're selling gadgets, and then you have selling to some wholesalers, and the rules are different as well. So we are not going to go into details of the sales and use tax and today, but just be aware that all different states have different rules, and this is actually one of the areas that company often miss. And when we do the due diligence and of the target companies, and we see that's being missed pretty often. Payroll tax, and the reason I bring up payroll tax is often that startup companies will say, hey, we don't have any employees, we hire contractors, right? Independent contractors. It has been pretty, I guess, the tax authorities has been pretty strict in classifying the workforce as employees or as contractors. And because of there could be labor law consideration, and there could be payroll tax consideration. And if somebody is an true independent contractor, the company paid them for their services, whatever. They send you invoice for like $100, and you send them $100, right? And the company would not do any payroll tax withholding, and would not need to pay any employer level of payroll tax. But if you have an employee that the company is responsible for tax withholdings and is responsible for employer level of payroll taxes, so that's extra tax burden. There's a kind of a bullet points and checklist of things what's considered when you say, okay, who is considered a contractor, who is considered employee. But a lot of times, the generally speaking, that for contractors, that you generally cannot really control, how they perform their stuff. You cannot really, restrict where they do their work, and you normally do not need to provide training because meaning that they have a lot of freedom in how they get their work done, right? But versus employee, there's a lot more control that the company can place. But this is a pretty key area for the government for audits, and because they often see the wrong classification, and which could have a tax impact on the company. Next. Okay.
Yeah, just before Jie continues, I want to remind everyone in the room. So like if you joined after our beginning, so if you joined midway, we are taking questions throughout the presentation, unlike last time. So if you have any questions or it feels like anything is unclear, we're just like is curious about a topic that you feel like it isn't like touched deep enough. Feel free to type your questions out in the chat box, and we will be taking them in the chronological order. Yeah, thank you. Jay, you can continue.
Okay. All right. So we're going to talk a little bit in details about the entity level income tax. And so with assuming this is a tech company C corporation, okay, and so we consider both federal and state level reporting, and sometimes, like for example, company could have multiple entities in the U.S. and there could be a parent holding company, and there's could be like one sub here, one sub there, and then when do we consider federal? If there's like a common control, then you could go to next level, or do we want to consolidate? Like the tax reporting, and when they come to state, and sometimes that even they say, okay, we're not filing consolidated returns for federal, but for state they say, okay, it doesn't matter what you do for Fed, and as long as you meet some requirements, we'll require you to file a combined reporting. So that's why it's important for your tax team to understand the structure and understand, like your state operations and what are the rules and everything, so they can, advise you on what's the proper reporting, or what are the reporting that could generate, the most benefit. And just give you a quick example that you could be having as I mentioned, like a parent holding company. And then there are several subsidiaries that are in very similar, industry. And then one of the companies makes a lot of money, and one of them doesn't, has a lot of loss. And if you file all the companies separately, then one company's loss cannot be offset by the other company's, income. But if you look at as a consolidated level, one company's income will be offset by the other company's losses, then you could have overall a lower tax. But that needs more detailed analysis and understanding of the company's whole picture. R&D tax credit, and that's available to like the generally speaking all the tech companies, and especially start companies when they do a lot of R&D, have a lot of R&D activities. There's one thing that started in 2022, which is I know the tech companies are not happy about it, and we're not happy about it, which is the R&D expense capitalization for tax purposes. For your financial reporting purposes, when you say, hey, I'm presenting to the investors on the I'm presenting my financial statement to the investors, right? And on that financial statement you're presenting, it will show your R&D expenses as expenses. So you have your income and you have expenses, right? And however, when it comes to tax, that you cannot deduct it right away, and we have to capitalize it. And meaning that we're moving your R&D expenses from your profit and loss section to your balance sheet section, and making it intangible asset for tax purposes. And depending on where the R&D activities are, if it's domestic on U.S. soil, then that R&D expenses, the capitalized portion, will be amortized over 5 years. And if the R&D happens in foreign country, then let's say we have an R&D team in foreign country, and that will pay somebody, like somewhere and outside the U.S. for the R&D services, then the foreign R&D are being capitalized and amortized over 15 years. This could have a very significant impact from the tax perspective. If your company is a very, very early stage startup, there's no income yet and all expenses, right? And this does not really put you into a taxable position, because it doesn't matter how much you capitalize, you're still at loss. But if your company is already generating income, and especially sizable income, and also at the same time spending a lot on R&D activities, this could actually put you from a loss position to a taxable position, and which could in turn generate, like ask you for a sizable tax and payments and creating some cash flow issues. So this is pretty substantial, and we have been waiting for tax law changes since they came out, and we're all hoping that this could be like removed. And but at this point, there was a little hope last year, but it did not go through, and so we're still monitoring and hoping that it could go through. And but at the best, at this point, we're seeing potential changes is there probably will not be any changes to the foreign R&D, meaning that they most likely will still be capitalized and amortized over 15 years. And but there's slight hope that the domestic portion could be allowed to be deducted, and which would help. And because at the end of the day, the government would like to encourage manufacturers and all R&Ds happen here, right, instead of outside of US. For related, and again, this is a part that's being missed pretty often. And I mentioned earlier about why we need to understand the structure is because a lot of structure will trigger required disclosures. And already mentioned about the related party transaction, right? That each missed form equals $25,000 penalty. And then there are foreign financial assets such as the foreign bank accounts, and those could even including okay, my U.S. company has a foreign subsidiary, and I own 51%, or I own 100%, right? You have controlling shares. In those cases, that your foreign subsidiaries bank accounts are reportable, are considered U.S. companies' bank accounts, and those are required to be disclosed. And so if they're missed, then the firm, there's $10,000 penalty. And or I have a foreign subsidiary, right, and I forgot to report it and on my disclose on my U.S. Tax return, and that's another 10. Like a penalty. So when it comes to firm reporting, in generally speaking, your penalty is starting at $10,000 flat, and it goes up from there. There are also other like one more thing I want to mention briefly is the transfer pricing, and this works when you have a cross-border structure that we see very, very often, that in the startup company world, that there could be a U.S. entity and a foreign entity, and it does not matter which one is parent, which one is the sub, and often that the two entities could have related party transactions. And for example, it could be selling products. It doesn't matter which direction it goes, okay? So it could be setting off products. It could be providing services. It could be providing back office services. And it could be lending and borrowing. And does not matter what type of the related party transactions are, and they need to follow the transfer pricing concept. What is it? Transfer pricing essentially is a like arm's length price that related party need to set for their transactions between them. And because from the government's view is like, okay, you have, if you are transacting with a third party and related third party, right, you negotiate, but you probably would not go care about how the other party, how much profit the other party makes and taxes they pay. But when you are related parties, and especially in the same, like a general structure, and you have a lot of flexibility and say, okay, how can we set a price? Then maybe that this company, this entity and the structure in this tax jurisdiction pay this much, and the other pay the other. And so there's a lot of like flexibilities and power for the related parties to set a price that not at a market rate. So the transfer pricing is essentially telling people, no, you cannot do that. You still have to follow certain rules and to set your price. And so it's reasonable when considering the general, structure, when considering the general market, and so far so forth. Next. Before we go into founder tax planning, any questions? And for the entity side? Okay. All right. We will talk about the founder tax planning. And this is some of the concept, the QSBS and 83B, and those are commonly for like the corporations. And we'll talk about, I will touch on the what's considered the QSBS and and what are the planning strategies, and on the next slides. And so let's focus on the 83B election on this one. So 83B, a lot of people have stock options, right? And there's like vesting schedules. So 83B election, essentially that if the election is not filed, it's not made, and then when your stocks are vested, let's say often there's like 4-year cliff, right? And when your first like 25% is vested, that by let's say right now when my grant price is like 1 cent, or a fraction of 1 cent, and let's say it's 1 cent, and in a year that we're growing really fast and going really good, and by the time that we do the 498, the fair market value now becomes $10 per share. And if we did not make that election, that essentially and your $10 minus your 1 cent, the difference is considered ordinary income if you exercise your option at the first year vesting. Okay. What if we made the we made the election? We made election, essentially we are changing the nature of the future appreciation from ordinary income, which is taxed at a higher tax rate, to a capital gain, which is taxed generally at the lower tax rate. And so I made my election. The 83B election normally is need to be made within 30 days of the stock issuance. And it does require you to actually pay that 1 cent to get the shares. And so essentially what it does is, okay, I make the election today, and I'm doing early exercise of my options at today's value, which is 1 cent. And I do not need to pay any difference between the fair market value 1 cent and my exercise price, which is also 1 cent. But my holding period start today. So 1 year later, and when I exercise, and if I have an exit, if I could sell, right? And I actually realize that $10 minus 1 cent capital, like the appreciation, that's not ordinary income anymore. That's capital gain. And if I hold it for over 1 year, from my date of exercise, that's considered long-term capital gain, which is at a lower income tax rate. So it is important that for founders, if you have the opportunity, make the 83B election. And another great benefit of the 83B election is tied into the QSBS, because stock options themselves are not considered QSBS. It needs to be the shares that's already in your hand. And so when you make the 83B election, it considers that you already own the shares, and which kicks off the starting holding period of the QSBS, which is could be a great benefit. I'm not sure if I have time to go into details about different type of stock option compensation, like the incentive stock options, the non-qualified, like the restricted stock units, and so far so forth. I will focus. I think our presentation, we have to 6 or a little bit after 6 for the presentation itself. So I will focus more on the QSBS and exit, event planning. So hopefully that can give people some ideas and tips of what to consider, and for the next step especially that if your company is looking good, it's going well, and you're thinking about exiting. Okay. So for QSBS, that it has to be U.S. C corporation stock, and as we mentioned, that it cannot be any other type of entities. And generally speaking, that the benefit is if the stock that you're disposing meets the QSBS requirement, you will have up to $10 million of federal capital gain, like tax-free income. And this is the more common, the $10 million capital gain is the more commonly used. But it also, there's actually another part is the $10 million capital gain or 10 times of what your investment amount, whichever is higher. That's actually the gain that could be excluded, right? So if you invested a lot and 10 times that could be way more than the $10 million, and you could also qualify if your shares qualify as a QSBS. And the shares need to be original issuance, meaning that either you got your founder stocks, or let's say you could be a consultant to a company, and they give you the shares, in exchange of your service. That could be original issuance, or that you inherited from your parents. That could be considered original issuance, or you could get that as a gift. All those considerations, all those are considered original issuance. And what's not is I bought it from another investor. I cannot get it from a secondary market, and that's not original issuance. And if I bought it from somebody else, then it's not QSBS. Okay. And also that depending on the state, some of the state will conform to federal law, meaning that they will allow capital gain exclusion, and some of the states do not. And California does not confirm, meaning that if you're a California resident and when you realize the capital gain, then that'll be subject to California tax. But for federal, you could get it tax-free, but for California, you still have to pay. So there's some plenty of opportunities there, right? Your state residency. And there could also be like utilizing certain trusts and to stack up, getting multiple gain exclusions. Like say, there could be 3 additional trusts and times 3, that's $30 million, and which I'll talk about a bit more later. Next. Okay. QSBS itself. I already mentioned that what like some of the general rules about what's considered QSBS. But if you do have startup company stocks, unless you have founder stocks that pretty much for sure I get it from from day one, it definitely qualifies, right? Because there's a $50 million asset cap, meaning that when I got my shares, the date of the stock issuance, that if the company has $50 million or more in assets, then my shares will not be considered QSBS. So this, if I got my shares from day one, when I formed the company, of course, I probably did not have $50 million, then it would qualify, right? But for the tranches I get later, then they may not qualify, because that $50 million include any funds I'm getting for different rounds of fundraising. So if this rounds I'm already raising 50, then whatever the stocks you're issuing is not going to qualify. But let's say, is there any plenty of opportunities there? Could be, right? Depending on where your company is at. If with the next round financing that we are going to reach that $50 million bar, and if you have flexibility, you could consider doing your fundraising in different batches, and maybe a small batch. So the stocks that issued upon the small batch could still qualify for QSBS, and anything after that would not. And so this is really depending on our company situation, but can be planned for, okay, to a certain extent. The $10 million is for married. Unfortunately, for married couple, they're considered one. taxpayer for 10. So there's only 10 that's available for married couple. Who are considered separate taxpayers, and anybody but the married couple and non-grantor trusts. And for non-grantor trust, and is it possible to say, hey, I'm going to set up 10 trusts and all with my both my kids as beneficiaries, and then I gift this trust my QSBS shares, and then the 10 trusts will each have $10 million of capital gain, like tax-free capital gain. Would that work? No. The trust, the non-grantor trust should not be identical. So normally that should have different beneficiaries in order for each of them to be considered a separate taxpayer for that $10 million exemption. But there are definitely opportunities that can be, can be used and for this capital gain planning. And however, that being said, that what's the best time of setting up the trust and doing the contribution of the QSBS shares is actually when the shares are still valued at very low. And because with the contribution to the non-grantor trust, the fair market value of the contribution is considered your gift to the trust, which will use your like generally speaking, will use your lifetime gift and estate tax exemption. Right now, it's pretty high. It's almost like $14 million per person. But if nothing happens by the end of this year, it will sunset to like half of that amount. And so if you are doing the gifting at when the value is already high, so you're actually utilizing a much higher number for exemption for the estate and gift tax purposes, and in exchange for a income tax benefit. And when the value is high, you may look and see if that's really worth it. And so the best time will be when the value is still low, then we're not really using much of our gift exemption, but yet we're getting the income tax benefit. Next. Okay. Capital gain planning in general, not necessarily the QSBS itself. Okay. Oh, one thing I forgot to mention about QSBS is what if I have not held for 5 years, and which is a requirement for QSBS. You can roll over into another QSBS, meaning that, okay, I have invested in this company, which is a QSBS stock for like 2 years. So I haven't met the 5 years. So if I sold it and I cannot get the gain exclusion, what if I, rolled it into investment into another small business that's could be considered QSBS and hold that for 3 years, and then I dispose it. Then your 5 years, then you will be considered meeting that 5-year requirements when combine the two. Okay. So capital gain planning. What if I don't need a QSBS and there will just be a capital gain, right? And this actually capital gain could be for, like some of the strategies work with both your stocks or your real estate or other type of assets, but we'll focus on the stock option, the stock transactions. So first of all, that there's timing. And if we have certain that, how to say that, if we have certain control on generating of the capital gains and also some other capital transactions, and when we expect to have larger capital gains, then we could have probably also do the loss harvesting, right? So we can offset of the capital gain with the capital losses we generate. Or if we have a, this is not a domestic case. This is when we do planning for people moving to US, and if they have capital losses, and we would love them to realize capital loss, and after they come here, come to US, become a US resident, but they realize the capital gain before they come. So we get the best of both worlds from a tax perspective. So there's definitely timing on when we realize, and if we could utilize, at the same time, generate some like loss transactions to offset. And Also, one common strategy is the residency planning. This could be for both federal and state purposes. Let's talk about state first. And for state, that we get a question a lot is, all right, I'm going to have an exit and event next year. Can I move to Texas? Can I move to Florida? Can I move to Nevada? And but when I move, my family is still in California, and I will be here quite often, seeing them at work here. And can I do that? And the other day when founders say, oh, I just bought a house in Florida, can I consider that my resident? I said, not really. There's a lot of factors, and states look. For example, if you want to really say establish residency in a different state, you do have to physically follow that residency, right? And you can now say I'm a Nevada resident, but I get my gas and get my groceries and all in California, and my credit card transactions all in California, and it won't work, right? And the often that we would really encourage you to get a local bank account and a local driver's license, and if you vote, and the local the voter registration information, so far so forth. You really have to take actions to really change your state residency. It cannot be on paper. It needs to be in fact. Okay, and otherwise there's very, very high risk, and for the state government to come back and say, hey, you did that to evade tax, and there will be an issue. When it comes to federal, a lot of times the federal can work out great, and not when you are a green card holder or citizens, because you will be taxed worldwide for the most part. However, for people who do not have the green card or citizenship yet, and let's say you're on H-1B, the working visa or some other type of visa purposes status, and you are flexible of moving out of US, then is there a opportunity for the residency change and save taxes? Yes, absolutely. So one time we have a client that who was on H-1B, was on the fence of getting green card or not, and then the family was also considering of moving out of US, and so we look at the status, and that essentially we planned a residency change as the beginning of the year. And because for the particular person that because of that he's on visa basis, and so we count the dates, physical presence, and that meaning if there are two prongs of tests when it comes to physical presence. One is this is for the people who do not have green card or citizenship, and so if the person for a calendar year, if the person is here less than 31 days, and we are not going to see the next level, we don't need to calculate the dates. Okay, he's considered a non-resident automatically. So if the person is here 31 days or more, and then we look at 3 years period. Let's say 2025 is a year that we try to determine the person's residency for US tax purposes. And when he does not have a green card or citizenship, then we look at 100% of number of days the person physically present in US, and plus 1/3 of the days he was here in 2024, plus 1/6 of the days he was here in 2023. So if those three numbers adds up to 183 and above, the person is considered a tax resident, income tax resident for 2025. So in this case, in the client, the case that where he was on the fence of moving out or not, and we look at with potential tax savings, and so we did ask him to move out before the end of January, the year. and he had over $200 million of capital gain that year, and that was not taxed by federal state, and which is over a $70 million tax savings. So it can be the residency planning could be pretty substantial. Okay, and some of other strategies is that the charitable remainder trust, and people may have heard about it. This is a great income tax tool, but it is not a family generational wealth transfer tool in general. Okay, I'll explain why. CRTs worked great when you have highly appreciated assets, because CRTs themselves are not taxed for both federal and state purposes. So let's say I have a stock or I have a real estate property. If I sell them, I will have a $5 million capital gain immediately. And if I do nothing, then I have to pay tax, right? So what if I contributed into the CRT? What's going to happen is the year of the contribution, I'm getting a charitable deduction, first of all. The deduction is not dollar for dollar. It's not like my fair market value is $5 million, I'm getting a $5 million deduction. No, and it's a formula based. How it's being calculated essentially is it looks at my life expectancy. It looks at what's the federal applicable interest rate. It looks at like how much distribution, a fixed rate of distribution I'm getting from the trust each year. This is predefined. And then they say, okay, based on this, a assumed interest rate, assumed like growth rate, and how much money will be left to the charity when I pass away, right? And we discount it to present value. And that present value is how much charitable deductions I'm going to get for the year of contribution. So this is the first benefit. I get a I get a charitable deduction. The second benefit is the trust will, I can be, or my spouse can be, or my children can be the lifetime income beneficiary of the trust, meaning that we can get lifetime income from the trust and at a interval that's predefined. Normally it could be quarterly, it could be at a minimum need to be annually. So you could kind of consider that as your self-funded annuity, right? Because you're getting a income stream each year, and the income is a fixed percentage of the fair market value of the assets in the CRT. And you have the freedom. You can be the trustee of the CRTs, and you have the freedom of how you want to invest the money in the CRT. Remember, the CRTs are not taxable entities, so meaning that the money that undistributed money that stayed with the CRT and can be invested tax-free, and it will grow tax-free. Okay, and you will be paying taxes on the money that distributed to you. And so there are pros and cons of this one. The pros are you're getting a kind of like a steady income stream, and you're getting the tax deductions. But the con is that you will not be able to use the money that's sitting in the CRT for personal purposes unless it's being distributed to you. So your part of the funds you can have access to is the distributions you're getting. And the reason I said it's not a family like a generational wealth transfer tool is because at the end of my life, the money in the CRT will be going to charities, not my kids. Okay, but I do have the option of choosing where we can go to, and it can be going to the Red Cross. It can be going anything. Could be going to a private foundation set up. It could be going to a donor advice fund, and I have the choice. But it does not go to my children. So there are definitely limitations. Okay. And
so sorry to interrupt here, but just want to be mindful of the time. We're now like actually 8 minutes past the allocated time, but yeah, we can briefly stop here and see if there are any questions from the audience. If there are not, or we answer like most of them, then you can continue. But yeah, just quickly pause here. And so for whoever in the room, if you are having some questions, whichever topic it touches upon, just feel free to send to us, and we can, Jia will answer them. Yeah. Yeah. By the way, Jess, thank you for your hour-long presentation. It's very informative. Yeah.
Thank you. So given the time that I'm going to touch on, move to the next session and going very quickly about due diligence. And because we have founder here, and so I just want to explain in general that if you're looking for, fundings and what are, especially in M&A or sometimes even in the convertible note investment world, that what investors could be looking at. And next slide, please. Okay. So with the due diligence that like what we're looking at, right? And are we looking at historical data? We're looking at projections, which one is more important and which, or less important. And it depends on which angle you're coming from. And I would say both are important because both will show different things and to the investors and for them to make decisions, right? And we'll go over a little bit in detail and what are and we'll go over what are on the due diligence report and what you will see when you get them, and what are some common issues that we observed and while we're doing the due diligence. Next slide. Okay, so because historical data, which one is more important, and it does show how's the company managed, right? And because it shows that like the competency of the teams and what you have considered and how you managed it, and is there like indication of lack of direction or planning evidence, and like too erratic behavior. You'll be surprised that what you can see from the historical data and how decisions were made is sometimes it's quite interesting. And but projections, right? Projection is, does company do budgeting? And are they being too realistic about their projections? And, like, are they just simply thinking this will definitely go, will fly, but sometimes the odds may not be as good as the founders think. And so what are the industry trends, right? So I would say both of them are important and when the investors look at your data, and because that helps them to, to evaluate from different angles. Next slide. What are on the reports? And so there are definitely some background information. For example, when we do the due diligence, and by the way, that we work with investors and often on financial and tax due diligence, and we need to understand the general background of the company. What industry, right? And what their legal structures, what their key management teams, and so far so forth. And we go through their financial data, go through their tax returns, and which I will explain a little bit more about what we're looking for. Next slide. Okay, so the key deal issues will be disclosed on the report itself, and including the structure, including like the working capitals, including the major liabilities, and so far so forth, and a lot of major contracts and some other analysis. And so it's a pretty detailed report for the most part. Detailed report at the high level for the more the key, more like the key items. Next. Okay, so the people often hear about like quality of earnings and what is it? And essentially, we present to the investors on certain report, right? And the report is that we show them, okay, here's our revenue, here's our cost of goods sold, here's our expenses. And from the investor's perspective is, are this valid, right? Not just valid, and will the company be sustainable based on these numbers, based on the trend? So the quality of earnings that we look at, the company's historical data and the industry trend, and as I mentioned, and some other like major contracts or price models and everything, and the sourcing of their suppliers, like a lot of different things, and we identify areas that should be adjusted, and in order to show a more realistic result for the investors, and before they make the decision. And we also look at, as mentioned, we also look at the cash flow and the working capital, and to see, okay, can the company even survive based on this rate of burning the money. Next. Okay. When it comes to tax, I already mentioned that, about R&D stuff and the state nexus and some of payroll tax issues, international foreign financial disclosure, and sales tax. And all these areas are areas that we have found deficiencies. And when we do the report, for example, when it comes to employment tax, and one time that we found it's not even on the company's financial statement, okay, and it did not make it out there, but we found the company had over $1 million payroll tax liability when we contact the tax authorities. And so it could be a very huge impact. And so the investor was actually able to use that as a negotiation tool to really knock down the price, unfortunately, of the target company because of that huge liability. And so things, sometimes the due diligence, there's no major things found, and which is a great sign. But sometimes there are major things. And for example, one cases we're working on right now, there are deficiencies in the firm reporting. The company did not report a foreign entity and did not report the related party transactions. So all those that when the deal will be drafted, the deal I believe will still go through, and when the deal being drafted, and so there definitely will be requirement from the investor saying, okay, you need to fix the things first. And normally we'll say, okay, there's how many years this issue has been in existence, and you need to fix them, and before we can release all the funds. And often there will be escrow, so there are certain things they reserve, and so this could impact some of the financial side of things for the deal. So it is important for founders and for companies to consider how can we making sure our financial data are good status, and how can we make sure our tax returns we're in compliance. How can we consider are we having a structure that will have the tax efficiency when it comes to exit, or when we come to mergers acquisition, or when we comes to just a business expansion. So there's a lot of factors that should be considered. Next. Okay, this is our last slides, so we're almost there. And so what other things we see are very common during the due diligence is, even though we don't do the legal due diligence, but we do see a lot of DIY legal documents, and sometimes there could be major deficiencies in the DIY legal documents that could in turn impact other things, right? And sometimes company expand very quickly, then there's a lack of attention to the operations or other things, and which can create a lot of holes in general, which in the merger acquisitions may not necessarily be in the startup's favor. And then we have found fraud, unfortunately, a couple of times during the due diligence, and then there's also lack of attention to financial that could lead to a pretty poor financial results, and sometimes that killed the deal. So those are the common things, and we have seen. I have a list of things which we're not going to go over, and to today, that what investors normally ask for different areas when it comes to tax, when it comes to financial. There's a very laundry list of documents that we request, and depending on what the investor is looking for or what the focus of the deal is. But we don't have time, and we're not going to go over today. So any questions?
Yeah, maybe also can show the last page for the PowerPoint. Yeah, so if people are interested to speak with Jie personally, feel free to scan the QR code there on the page. yeah, Nick, you asked this question, so yeah, you can definitely contact Jia personally. Yeah.
I think this audience is very kind. You do not ask a lot of questions.
Yeah.
But feel free, and if you do want like a copy of the slides, or you have any questions that's very specific to your personal situation or the company situation that you want to reach out and chat, and feel free to contact me.
Yeah, and also if your company happens to be international or has international branches, then Jia is probably one of the perfect people you can ask. She has a lot of like experience in the field. Yeah.
The just very quickly that we work with businesses and individuals and around the globe. We have like a audit department, so we can support our clients with the financial audit needs. And we have a client accounting service team, which we do financial and accounting advisory work. And we have a domestic tax team, we have an international tax team. And so we work with the clients from, like consulting and tax return preparation and financial accounting audit and so far so forth. And so there's a lot of things that we can support our clients with. And so feel free to reach out to us if you want to chat about it, and we'll be happy to help. And also just want to add very quickly, our firm is a member of Prime Global. That's an international accounting association, which has member firms in over 90 countries worldwide. When our clients have needs in various countries, and they are a great resource for us. And for example, I just have a client reach out and recently say, hey, we set up a subsidiary in Brazil, in Spain, in Saudi Arabia. Do you guys have any member firms in those local countries? Because we need payroll, we need a tax, we need accounting support. Then we have the member firms we introduce to our clients, and then they are in good hands. So.
Yeah, perfect.
Okay.
We will be staying here until 5:30, so feel free to think of any questions if you're still trying to digest all the like dense information presented. Yeah. Oh, and I forgot to mention, if you want to attend similar sessions in the future, feel free to scan the QR code on the left column. That leads to Founder Coho. So Founder Coho is the event organizer for all of these kind of sessions. Yeah.
It is really kind audience.
Yeah. Exactly.
So the since we still got time, and not necessarily on the founder tax and stuff, so I'm just going to speak a little bit more, and feel free to ask questions, or like you want to chat. And so we're often, founders often ask that do SAFE or convertible notes qualify for QSBS? And the answer is that it depends. And normally they're not, and before they are converted to stocks. Okay, so because the QSBS is worked on stocks, on shares, not on a like a promise. And so for convertible notes to be considered, it actually need to be converted, and for SAFE it needs to be like on the when it's converted to shares. But sometimes it's a little bit hard, and when you have the SAFE, because often there's like a triggering event, and like two common triggering events. One is when there's a next round of fundraising, right? The SAFE will be converted, and or sometimes even there's no next round of financing, but there are the exit, and it will be triggered then. So in both cases, that let's say if it's already exit, and then you definitely won't meet that 5-year holding period. But if it's with the next round of financing, then maybe right. Yeah, next round like fundraising, maybe if your shares converted as the next round, and then at that time, the company does not have $50 million of like the gross assets, and then you may qualify, right? There are some other like fine details on the QSBS, which I did not mention earlier, is like there's industry requirements. For example, if you're in healthcare, if you're in like banking, financial services, those industries do not qualify.
Yeah, we have one question, a new
Okay.
question from Leo, who said, any tax planning suggestions for UK founders?
So there's it's not necessarily UK, but there's a coordination of different country laws, right, in treaties, and depending on your status, if you are like a US resident, or you are a UK resident investing in US company shares, and so there could be a difference. And for example, for UK, for non-resident alien funders who do not have U.S. green card citizenship, or do not have, do not meet the physical presence test, the number of days test, and then your investment in a U.S. Like a corporation, and if you have exit and you have a capital gain, the capital gain is completely tax-free, and for U.S. tax purposes. So the taxation is depending on your personal status and the type of income, and the timing. So. But there are a lot of coordinations between the countries, and especially when there are tax treaties.
Yeah, there will be recordings for today's session. I know so many info being covered. So just follow Founder Co-host YouTube channel. We'll be posting all like kind of event recordings there. Yeah.
Sounds good. Well, thank you.
Thank you, guys. For the last minute, of course, also feel free to post any questions. I personally have a question for Jie. So as like an aspiring founder, you mentioned, I think on the last page, that said like if you're early stage, one of the biggest mistakes people make is that people are not cautious about budget planning. So can you share maybe like the top 1, 2, 3 budget like planning mistakes early founders make in terms of tax and all those kind of
Sure. The most common one we see.
Yes.
When you say planning mistakes, and it just can be in any areas, and what we see quite a bit, is the tax non-compliance. And I actually have one case that the founder or the team, again, you'll be surprised that it comes more often than you think, and it's related to the payroll tax as well. This is not the $1 million, like the tax liability were found. This is another case. It's not a $1 million, but it was pretty large amount, and that actually killed the deal as well. And because what happened was the company was paying the $1 million was actually the liability is actually partially was a fraud and related, but this one case that is purely because of the founder and the management team, or the accounting team, whatever. It's a startup, so there's really no true accounting people. And what they did was they thought they paid the employees the payroll. They thought they filed all the taxes, but yes, they did. They paid the payroll. They paid the salaries. They filed the payroll tax returns, but they did not pay any taxes. They did not remit the taxes to the government. And so in those cases, it's a lack of knowledge. And they were not checking with anybody. They thought, okay, we just paid this one, we did that, and we're done, right? Wash our hands, we're done. But that's not the case. So a lot of things we see is really because the team are, essentially, you don't know what you don't know, right? And so that's why is very, we really encourage founders to reach out to legal, reach out to, like the CPAs, and to at least get understanding of what should I expect right? What are the key things I need to pay attention? And so you can make some educated decision, or, like in your operation, in your running of the business, and instead of stepping into this, like time bombs and later on, and so, oh, I did not know. Sometimes it's too late.
Yeah, thank you. We have 2 more questions, so those will be probably our last 2 questions for today. So George asks, he's curious about how much the e-commerce tax is.
I'm not sure what's the e-commerce tax. Can you like explain where?
Yeah, maybe like explain a little bit more. We can move on to the next question. So Abraham asks, he's using sole proprietorship now because he has no revenue yet, and his CPA doesn't recommend him to incorporate. He's working on a demo round. Jia, can you comment on when to get incorporated?
Okay, so for sole proprietorship, that you get the benefit of your losses, right? And because everything is reported on your personal tax return, so you do get that tax benefit. And if you are expecting to raise funds and things are looking good, you're expecting to raise funds, and I do recommend that like probably consider incorporate then. And one thing I have heard, like from the legal side, this is not a tax consideration. There's more than just from the tax perspective. Okay, there's definitely other business and legal considerations. And I have heard, like for example, from legal perspective, if you where you're creating, will have certain IPs and stuff, right? And do you want to protect it? And then sometimes that if we have seen a lot of start up like the entrepreneurs, and that they started their business or testing, creating things, and maybe while still working at another company. And then when do you want to incorporate? And if there's very sensitive things and the potential legal issues, and then you may want to like incorporate in after you're leaving the company or something. So there's more than just tax and going into the decision. And but I would say, generally speaking, that if you are thinking of or like a fundraising, I would say that's when it's appropriate to consider to incorporate.
Yeah. So George specifies that it's e-commerce tax.
Okay, so for the e-commerce, that you still have your the income tax and sales tax. So there's no specific e-commerce tax, and but what you would consider is still, even for the e-commerce industry, that what I mentioned earlier about the state nexus for sales and use tax and for income tax still apply. And because often that for e-commerce that you could have using the Amazon, right, service, you could have your own website, and you could using other means and to sell online. And sometimes like without you being aware that Amazon already have a warehouse somewhere, and that could if you have a substantial income from a place where they have like warehouse or a substantial inventory, that could unintentionally trigger some of the nexus issue. And so it depends on at a very high level, and it's still your general taxes, and will still depending. The federal is the same. It's a flat tax rate, 21% across the board on profit. And but for state, it could vary. And each state has different formulas when they consider how much will be subject to their specific state tax, right? And different states have different tax rates, and some have much lower, some much higher. And being New York and California are in the higher end of things. And so, one question we often get is, can planning be done when it comes to state taxes? Yes, to a certain extent, and because this means that you will need to really be able to, if you're in the situation that you are, you have a very good understanding, or you can project that where are my major customers are, then that's when it is possible to plan. But if you are not sure where my customers will be, or they'll be really spread out, it really depends, right? I can't control at all, and which is very often with e-commerce is I cannot really control where my customers are, and it's a little bit harder. So, but
Right. Thanks so much, Jie. And that will be the end of our 1 hour and a half session for today. So thank you for everyone who joins with us today. We will be hosting more sessions, so please make sure to follow us. And of course, if you are considering to speak with Jie, her contact info is on the page right now, so you can take a picture, scan the QR code, or note down the email so that you can later contact Jie privately. Yeah.
Well, thank you.
Thank you so much. Yeah, and have a very wonderful night, everyone. And goodbye. Bye-bye, everyone.
Bye.